Hello and welcome to Core Finance. It is Monday morning, coming to you from the heart of London. I am Matt Brown and I'm joined today for the weekly slot with Tim Harrison, who is Head of Wealth Management at Linear Investments. How are you today? In fine fettle on a lovely Monday morning,
well,
I assume.
What an introduction. Good morning. Well, it's grey and overcast outside. The market's a little bit softer this morning. One would suggest another quietish week. With no real major companies reporting. I suppose everyone's looking out for Jackson Hole and whether Yellen, Draghi, et al. Come out with anything to spur the FX markets and the equity markets en masse.
And it felt, we saw a little bit of a sell-off, obviously, at the back end of last week, really kind of driven by Trump and Trump politics. Do you think that will spill over into this week as well?
Well, I would suggest, barring the fact that the US Navy ships crashed into an oil tanker, no doubt someone somewhere's going to get their knuckles wrapped over that. The whole Trump story seems to be just dragging on and on and on, and they're talking about the Trump slump, the Trump dump, as a result of a lot of his push through not coming to fruition. I mean, in terms of the markets, it's obviously creating a bit of interest and keeping things, sort of fluid over what is historically a very quiet time. But as yet, we're not really seeing anything dramatic. It's just a bit of a pain trade. It seems as though traders are pretty bored, just sat on their hands, light selling, nothing really aggressive, and we're not really seeing any real direction. So I'm just hoping and praying that St. Leger's Day can come sooner and we can get back to normality.
And on the corporate front, any kind of results to look out for this week? Anything to maybe wake a trader up?
Well, I would suggest, obviously, you've got the likes of the BHPs, you've got the likes of Vedanta reporting this week. Obviously, their stablemates, the Anglos and the Rios, have reported already. Reasonably robust figures over the last couple of weeks, mainly on the fact that commodities prices have been driven higher on, potentially China appetite, etc. So there'll be a couple of names to watch out for, I would suggest. And furthermore, you've got Persimmon. Again, you've got the housing market, has it called Brexit, etc., etc. Now, obviously, as a company, they updated the markets last month with a reasonably bullish outlook. So anything there that's slightly negative, you could see traders take profits. But again, anything to suggest that they are ahead of where they expect to be, then again, you could see buyers step in. But as yet, as I say, this week is another week like last week where there's nothing really to grab hold of.
This morning as well, we've seen Rathbone brothers have confirmed a merger with Smith and Williamson. Again, another merger in the asset management space after Standard Life and Aberdeen. What's your take on this? Is it a case of asset managers now need to merge to survive?
Well, again, it's a case of you've seen this sort of trundling along for quite some time. You've obviously seen the likes of Investec, for example, many years ago, picking up Williams de Bro and looking to go into the private wealth arena. As the costs of running these sorts of businesses are becoming much more impactful, there is less and less margin. So it's not so much a brain drain, if you like. It's more a case of companies looking to consolidate to get the intelligence, the computer-driven software, the risk management software, etc. So that's really where they're going. Obviously, Rathbone's quintessentially old-school, blue-blooded broker, getting into bed with Smith Williamson, which is historically more on the accounting side of things. It's an interesting merger, probably a merger of desperation as opposed to opportunity. A bit, I would suggest, dare I say it, the Aberdeen and Standard Life. But I do think it is the start of, or a continuation of, what you could see further consolidation within the asset management space.
But it's always tough with a bull market. People are compared against indice trackers, so the likes of BlackRock and Vantage. It's hard for fund managers, but where they really come into play is when we see a bear market, where they really are start to pick the value and look after client assets. So certainly if we see more of a bear market, then hopefully a lot of these asset managers will now start to outperform the indices.
One would suggest, but again, you note over the weekend, for example, Crispin Odey's fund performance over the last wee while has been pretty drastic. But again, he's praying for a bear market, he's praying for a correction, and that really is when the stars really do shine.
So we look forward to obviously Jackson Hole at the end of the week, but it feels like another quiet week this week. Tim Harrison, Head of Wealth Management at Linear Investments, thank you very much for joining us today.
Thank you.